All right, thanks, Rira. Yeah, I've got the, yeah, 1 second. So, hello everyone, thank you for joining today's session. Today we'll just go with a brief on the production and cost analysis in the oil and gas field development planning. So, field development planning is one of the most important and critical area in the oil and gas industry or in the entire life cycle of the oil and gas se- sector. Just a second, guys. Okay, fine, thanks. All right. Oh, Just so let's get started here. All right. So as I said, field development planning is one of the most critical area in the oil and gas industry. So the oil and gas industry, we have three segments: the upstream segment, midstream segment, and the downstream segment. Sorry, before we head over to the subject, I'll just say about myself. So I'm Vikas Kooneti. As Shrirag said, I've been in the industry around 6 to 8 years. I've been mostly focused on the energy economics side, working with two or three energy companies in the North Sea, mostly focused towards the optimization area. And field development economics have been working on one or two field development economics projects in the past. So it's quite a challenging area and the uncertainty is very high. So that's the main reason having a knowledge and good understanding of the main areas. How do you improve your cost? How do you improve your recovery? Is mostly the main area of interest. So as I was saying, heading over to what we were discussing. So there are three areas in the entire life cycle, or let's say the entire segment of the oil and gas industry: the upstream segment, midstream, and the downstream segment, right? So the upstream segment is where the exploration to production happens, and the midstream sector is where the production is then goes to the distribution, and in distribution, where it's distributed to the retail market and goes to the downstream, where downstream is where it's the end user or the consumption, consumer area. Okay, and this is a big chain, and it has a lot of capital. It is a highly capital intensive industry and highly risk associated industry. So this is a critical area where any decision, any type of methodology, any type of uh, elements that are you going to consider or trying to play around or play a big role. Okay, so considering we will be mostly focusing on the production side, which is the upstream area. So the upstream segment is considered of four areas, or let's say you can say five, but mainly it's four. One is the exploration stage, where you are at an exploration area. You find where is the oil, where the hydrocarbons are located. Then you do a bit of reservoir engineering. Reservoir engineering is the second area. Once you are thorough with understanding of the reservoir, you head over to the drilling and production, which is the third area. You can break drilling and production separately, or you can combine them. It depends upon how we're going to consider this. But as a learning aspect, drilling and production are two different areas, right? And lastly, once your production is, once you start producing oil, then you work on the economic side, right? But this is like a cycle, this is like a structure aspect. But if you see the overall element, everything is integrated and interlinked, right? So when you do a FDP project, when you go for an field development planning, or maybe if you have an existing wells, if you're going to for a scaling, or maybe if you're going to expand your field, right, you might have to then think in different aspects, right? So what is your main area of interest? What is your scope? What is your cost limits, or what is your budget, and what is your time planning, or um, and then what is the quality do you have, right? So these are the four basic fundamentals you will be considering, right? Time, cost, scope, and quality. Okay, everything is interlinked or indirectly associated with this, right? Because the scope is the main element, right? So imagine if you want a production of n number of barrels, right? How would you do that, right? What is the optimizing method? Are you going to optimize it, or are you going to create a different structure of production, or are you going to limit your production, right? Why are you doing this? Is that because the oil prices are too high, or is there an uncertainty, or is there a sudden peak of oil demand due to some reason? You need to have a clarity on this. Similarly, That's in terms of scope. Similarly, the cost, right? Now, when you know you are going to produce a lot of oil, right? You need to make sure how are you going to produce? Are you going to spend a lot of money to produce it? And will that come with a break even? So, is there a break even in that, right? And if there is a break even, how much how much profit would your company or your organization would make, right? So that's an understanding or an analysis you should have in a very let's say pragmatic manner, right? And that's the main purpose of doing production and cost analysis in oil and gas field development plan, right? So end of the day, what matters? The net present value of your field matters, the internal rate of return of your field matters, what is your payback returns, and what is your productivity, sorry, a product profitability index matters. Okay, apart from this, there's different other elements as well. Let's say return on investment, um let's say different type of structural approaches, which you could say, saying okay, I would want my production in year one to be so much, year end to be so much, and how do you mitigate that, right? So there are different approaches you take for your end results, right? But end of the day, what are you going to do? Are you going to go to an investor for saying that okay, we have a field, we are doing a production, but we want to expand it, we need investment? Is that the point, or is it like, are you going to a lenders? How would you kind of create this, right? That's one question. Second is, do you have a budget? Okay, so mostly what happens is, okay, you might have an investment, but you need to have a budget, right? You can't overspend the money, right? Maybe your production, let's say, reservoir conditions are not good. So in that situations, what happen is, when your reservoir conditions are not good, you might have to, let's say, spend a little more money or little more cost on, in your production optimization, right? So you need to understand, will that be feasible or not? Will that be an applicable manner or not, right? What is the trigger here? That there are two triggers. One is your production, and one is the oil price. Okay, so if both are, let's say, balancing in a right manner, then yeah, we can go for a production. But if maybe you're spending a lot of money and there's only little hydrocarbons being recovered, then you're at a situation where you're losing a lot of money and recovering very less, which will, end of the day, you'll go for a loss or a bankruptcy, right? So these are a lot of things we would kind of get over in the future programs. But today we'll just go for basically an understanding of production and cost analysis, to the let's say the basic elements in what we were discussing, right? So as said, right? So unlocking, one second, why is this? Okay. Yeah. So unlocking value through strategic forecasting and budgeting, right? So production and cost analysis. So production and cost analysis are you need to balance between each other, right? You can either spend a lot of money and recover less, or you can either spend a lot of money and recover enough, or maybe recover more, but you're losing a lot of money, so it won't break even, it won't match your numbers, right? Or you can have a lot of production at a very less cost, but what are you going to benefit it? You will benefit only if the oil prices are in a good condition, or are high, right? So this is an area of an interest where you need to know how do you monitor or mitigate in situations, right? So field development planning requires major upfront capital and long-term planning, right? So end of the day, it's all about planning. What are you trying to do? You have a production, there is a field, there is production happening, and what are the costs associated. You have a plan, you have a, let's say, lifeline for next 30 years or 40 years, right? So you need to plan optimize you need to plan very optimistically. The main purpose of planning optimistically is just to save money and increase production, right? So that's the main goal. So accurate analysis supports, basically, if you have a good understanding, how do you mitigate this, and both the cost and production, comes in a situation where you have an accurate analysis which supports in investment approval. So if it's a greenfield project, imagine your let's say you're just at an exploration stage, or maybe just came up with the licensing, right? You're at an investment approval stage, right? So in this stage, you might have to do a thorough production analysis, or you might do a thorough entire FDP plan, right? Then technical optimization, right? Technical optimization. So how are you going to optimize the well? So once you know the reservoir conditions, once you know how the reservoir is playing around, how do you where the hydrocarbons are located, then based on your, let's say, the technical optimization, let's say, based on that, you might say, okay, I'm going to do my primary recovery for let's say 6 7 years. I might be doing my tertiary secondary recovery maybe for a very long time, maybe 20 years or 25 years, and maybe I might go for a EOR or enhanced oil recovery or tertiary recovery after 25 years or 30 years, right? So this is a technical optimization, right? And what techniques would you use? Are you just going to go for a single production well, or maybe you might have one producer and two or three injectors? What's the method, right? What's the methodology, right? That's the thing. Then economical viability. Now, economical viability is an area where you need to understand how would the oil price play here. So the main area which is uncertain in these conditions in general are your oil price as well as your production, right? Production maybe at some way or other you might forecast, or maybe some numbers which you're confident at, but the oil price is totally uncertain. So you might take an average, or maybe you might take some market reports and do a bit of analysis of that, do a bit of regression modeling, and try to say that, okay, I might take an average oil price at, let's say, this number, and with that you play a scenario analysis, right? That's the main purpose of doing an economical viability. Apart from that, what is your capex and opex as well, right? So we'll discuss that in the next slides. Apart from that, affect facility sizing, drilling strategy, and timing of your cash flow. So when you say field development planning, or let's say when you go for cost analysis, it's not just about production. It's not okay, you have existing wells you're going to produce. Maybe if you go for a new drilling, maybe you might go for a new drill campaign, right? How would you plan that? So these are all an area where you might have to be very optimum in saving money. At the same time, you need to consider yeah, stable production. You might not go for an very high production just to you have oil, because if the oil price don't match at a right, in the right way, you're just wasting production. Instead, you can put a stable production and kind of go for, maybe when the oil prices are high, you might increase your production. That's an option, right? So production, right? So production is a very simple way. There are two methods. One is, you have an historic data. So if it's an existing well, you have an historic data saying, and there's an average production of a number of barrels, let's say 500 barrels, 1,000 barrels, whatever, right? In different locations, it's a different type. If it's in the Middle East, you will have more than about 100,000 or 200,000. If it's in North Sea, now most of the wells are depleted, so you have around 3,000 5,000, let's say around 3,000 to 5,000 per day production, right? So that's how you're gonna consider that. I mean, each well is different and each production is different, but if you have to forecast, right, how do you forecast, right? So in let's say production analysis or production forecasting is a very complicated, you can say complicated, but at the same time simple manner, right? So forecasting future production rates in oil and gas field involves estimating the volume of hydrocarbon that will be produced over time based on geological engineering and historical data. This is typically done using different methods like DCA, which relies on past production trends, material balance, which uses reservoir pressure and volumetric data, and numerical simulation, which models fluid flow in the reservoir. Accurate production forecast helps in optimizing field development design, facilities plan, cash flow, uh, and economics as well, right? And SS economic, project economics, right? So simple to complex, right? So let's keep it DCA, right? DCA is a very simple approach, which is decline curve analysis. You simply use basic mathematical formulas, like say you do hyperbolic decline, harmonic decline method, or a exponential decline method, right? You just use a very simple formula, and based on time, right? So considering your time, these values you're gonna just consider and say, okay, today the production is 500, tomorrow it's going to be 498, and that's how you're gonna decline it, right? That's a proper decline curve analysis trend you would use. However, decline curve analysis is mostly either you have past data, or maybe you have a certain calculations which, sorry, certain values which you're either confident or you're certain with, right? You just use those numbers. However, keeping it a bit more precise, you go with the material balance equation. Material balance equation, you need to have the reservoir data or reservoir values and the calculations, right? So you might do a stock tank barrels in place, and you might do different volumetrics or PVT data analysis and reservoir conditions. You just consider all these and come with a number saying that a number of barrels are underneath the reservoir or underneath the subsurface, right? And based on that, you again use that and do a DC, or maybe use a different approach based on your production, right? Every day you might use that and say, okay, this is the decline we're going to have, right? Lastly, you have numerical modeling. So once you are thorough, once you're at a production stage, maybe for a while, let's say 1 or 2 years, or maybe even during the initial phase, right? You might collect a lot of core data, core samples, a lot of you might have a proper structure of how your overall reservoir is, right? So you might do a proper reservoir modeling, and based on your reservoir modeling, and as you have a lot of reservoir estimates and reservoir characteristics available now, you might do a proper numerical modeling using commercial software, or maybe nowadays you use coding and all this stuff. But yeah, commercial softwares are more viable still. So use a commercial software, understand how the reservoir is, how the reservoir playing, it's how it's moving, and based on that, you where do you drill, where do you, how is your production, is it stable or unstable, and how is the production overall flow happening, right? So this is the numbers you will receive. The main purpose of having this number is just not to know that, okay, my production has happening, there's a decline of so much, or there's a stable production, or there's an average production. No, the purpose of having this production is how would this production play a role in terms of your cost analysis, right? So now imagine your decline, your well is declining. Fine, you know the well is declining, but at what rate is it declining? Is it rapidly declining, or is it declining it, let's say, to not very, not rapidly? So you need to understand that, right? So you need to understand what is a critical area. Again, going back to the scope, right? So is it that you want your well to last little more long, or do you know that there is still a probability of maybe going for another drilling and maybe extracting some more oil, or is there a probability of now saying that, okay, we are at a depletion stage, maybe we might go for an tertiary recovery? Is that the situation, or what is the main condition now you have, right? Based on that, you might go for a cost analysis, or you might go for a new decision, right? Saying that, okay, now this time we might go for, let's say, increase, putting up new capex for enhanced oil recovery, or maybe improving our opex. Maybe we might do different type of water flooding, or a different type of production, right? So that's our approach. So that's the main purpose of having these numbers, right? And obviously you multiply that with your oil price, and that would be the that would be basically the value you would generate as well. But the main purpose of having a proper understanding of production data or production forecasting is to plan ahead for a long term planning, right? Now your production data changes with time. Okay, so maybe let's say this year you have made an estimation of a number of barrels, and each year this would be the decline and whatever, right? After 5 years, that numbers won't be the same. Your entire um, calculations would be different, because now what happens is, now you are at an actual data. Now you are not forecasting anything, you're at an actual data. So your numbers may slightly be here and there. Maybe your production, your forecast matched, or maybe your production, sorry, your forecast was a bit uncertain. But the main purpose of having a forecast is just for an approximation, or for an decision making aspect, right? Now, how would the reservoir play underneath, and what are the conditions in the reservoir is not are always not known, right? Sometimes a reservoir can be very simple and no problem. Maybe you just drill it, properly, and there is production happening. Sometimes it's not that case. Maybe it might be hard for you to drill. Maybe the reservoir has a very different conditions which might collapse your well, or your production may be unstable. There might be a lot of wax depositions, in your production well. So there might be a lot of conditions that might affect your overall production, and end of the day change your numbers, right? So if that is happening, then again that plays a big role, right? So you might, okay, your reservoir conditions say you might be having around, for example, you might be having around 500 barrels production every day, right? But when your production is coming to the surface, you're only having 200 or 300 barrels. Okay, what is happening? Where are those 200 barrels going, or why are you not receiving the other 200 barrels, right? There might be a wax deposition, or there might be a uncertainty underneath the reservoir. Maybe the reservoir condition is not that suitable, that the pressure and temperature are in a good position to extract that way, right? So what happens here is, now you might go for an opex. Yeah, you might increase your opex at this point, or maybe if required, you might put up an injector or something, where you might go for an let's say extra capex or additional cost, right? So this is another purpose again for having a proper understanding of production forecasting. Now, As said, production is simple to complex, right? So decline curve analysis, it's used for existing wells, mostly for existing producing wells. Method use historical production data to predict future output. Best for mature fields with stable production data. Limitations assumes no changes in operations, and this is the thing, right? When you say there is no changes in the operations and you know the conditions are very good, that's not how it is going to be. The numbers, the data would be different, right? Similarly, material balance, right? So used for appraisal stage, early development, right? So estimating hydrocarbons in place using pressure and geological data. So you use a stock tank barrels in place calculation in that way. Right, best for linear field screening before production starts. Limitations less accurate with production history, right? So you don't have a production history, but you know how your reservoir would be, right? So you know your pressure, your temperature, your porosity, permeability, um, your gas oil recovery ratio, and all these things, these values, and based on that you calculate a stock tank oil in place and saying this much barrels of oil is underneath present, that's how you would go for. But maybe once you initiate your production, you might know what's your decline rate, and you might know and how much is the barrel, so you might have a proper understanding, then you can go for a production forecast in this aspect. Reservoir simulation. Now, last but not least, this is mostly used for greenfield or complex reservoirs, right? Methods, physics based models using rock, fluid, and well data is considered best for new development, enhanced soil recovery, limited limitation, data intensive, and time consuming. So, reservoir simulation is it's very complex again. Mostly reservoir simulation is mostly used where once your production is started, or once you are at an, let's say, after FID stage, right? So in the oil and gas industry, when you go, when, let's say, before commercializing, right? So FID is like final investment decision, right? So uh, till FID stage you might just go with the DCA or maybe material balance, because you only have this data, you know what your you might only go with the material balance, right? So you might only have this data, or maybe if your well is if it's an existing well, you might only go for, you're using DCA data. But what happens here is reservoir simulations is mostly done when your reservoir is too complicated, right? There are a lot of changes in the reservoir happening, or you might go for a different type of approach now, right? So here if he says like going for enhanced oil recovery, right? So you need to understand how your reservoir is it fine for your, is it good for you to inject polymers, right? Is it good for you to inject chemical? Is it acid reflux, and if, or water flooding, does your reservoir bear these conditions? Is it fine, or will the reservoir damage or collapse, right? That's the main purpose of having this screen. It's more like a diagnostic test. That's the main purpose. Then again, mostly for new developments, once you have a lot of data, some messages here. Hi, who is this? Hi. Oh, okay, someone. Sorry, I don't know. Okay, sorry guys. So Uh, yeah. So data, sorry, new developments, right? So once you are at an FID stage, you know how good your reservoir will be. You have all the reservoir data, you have every numbers available with you. So now you can create a proper reservoir model, and based on your reservoir model, you might after your well planning, again, once your well planning stage is finished as well, you might say, okay, I'm going to drill here. My injectors would be here, my producers would be here, or I might not have. Sorry, I might not have injectors, I might only have producers because it's a primary recovery. So considering this aspect, you create your reservoir simulations, putting all the subjective values, right? So what is the depth of the reservoir, what is the porosity, permeability, gas thickness, pay thickness, and everything, right? Once you add them, your the commercial softwares are designed in a way where you literally can see a 3D model of your reservoir, right? So that's the main purpose of having a reservoir modeling. And once you know this, you try to just play around with numbers to just to see that how it would affect your overall production, right? Now, let's say once you start your production, okay, once, let's say, let's say it's a new field or a green field. Once your production is initiated, once you start your production, what happens here is, you initially, maybe your production is little high, this number, it will go very high, and it will come to a point where you are called as, like, let's say, peak production or peak production plateau, right? So at this point is where now you can either stop your primary recovery, and that's it. This point is where your primary recovery is going to end, because that's it. Maybe here you have, you see, 10 million barrel, 12, 15, and go still 30 million barrels and 32 million barrels. Okay, each well or each reservoir is different. Okay, each field is different. Sometimes this curve can be a bit more lengthier or thicker. Sometimes it can be a bit more thinner as well. Once you are at this point, now here you start your secondary recovery, which means now, okay, there is the decline has now slowly reducing, right? So the decline is slowly reducing. Now you have two options. Either you can just go ahead with that. If you go ahead with that, the decline can go very rapidly, and maybe instead of going till 2039, it can just finish at 2030. Instead of that, you might use a secondary recovery method. You might just go with the water flooding, or maybe stabilize your production, right? This way what happens is you can expand your this line, expand your production for a little more time. But again, this is subjective. And then after a certain time, when you see here, right, you're at a point now, the you only have 4 million barrel, right? You only are at a position where you're only producing 4 million barrel per year, which is very low compared to what you were having, 32 million, 31 million barrel, right? At this point, what happens now is you will go either for an enhanced oil recovery, or maybe you go for an abandonment, right? Mostly people go for enhanced oil recovery because that's a good way of taking an approach, right? Or you might go a bit more seismic survey. You might go for a little bit of more numerical modeling, and try to say, okay, there is still oil in that corner, or still oil in this place, and just try to do a bit more analysis and go and start drilling there, and maybe try to find oil. And maybe with that there can be a slight improvement here, but mostly that will not be above, let's say, 10 million barrel in general, right? So main purpose is, again, daily annual production rates, forecasted volumes used to estimate revenue, and design production facilities, peak plateau and decline phases. So this is the peak plateau stage, a production stage that guides cash flow, timing, and operational planning, and an estimated ultimate recovery, which is the total hydrocarbons expected to be recovered during the field life, right? So critical for economic evaluation. So simple. Once you when you do a material balance, what's your your estimated ultimate recovery, right? So estimated ultimate recovery is like the total a number of barrels underneath the subsurface. So that would be, let's say, you're gonna have an average oil price, and you're gonna multiply that with your oil price. So you will know that is the value of your entire field, or value of your entire uh, project, right? Now this is subjective, because at the initial stages it's very different to once you start your production, and with time it changes all the time, right? So your EUR also changes with time. Now, once you know how your production is being happening, and is a well good, all the conditions of your production engineering aspect, drilling engineering aspect, you're at a good stage now, where let's say you have a stable revenue or production. How do you now deal with the money part, right? Or let's say the cost part, right? So the cost is only basically of two to three main elements, which is capex, opex. Maybe you'll have taxes, and the other agreements, contracts or agreements which you would have. But mostly it's OPEX and CAPEX and ABEX, right? ABEX is nothing but your abandonment cost. Nowadays, abandonment cost is, considered critical. So abandonment cost as well, right? Abandonment cost mostly can be around a percentage of your capex, or a percentage of your overall capex and opex, depends, right? Or maybe you might have an estimated apex in at an initial stage, saying, okay, this much will be my estimated apex, right? So cost analysis in oil and gas field development planning involves estimating all expenses required to explore, drill, build facilities, operate, and eventually abandon a field. Okay, it includes capex, which is upfront investment like wells and infrastructure, OPEX for ongoing costs such as maintenance, logistics, and obviously decommissioning goes in the ABEX, right? So accurate cost analysis is uh, essential to build effectively and assess project economics and support investment decisions. Now, the main purpose here is, uh, sorry, this was only for the last, not this. Right. So mostly this is seen sorry, mostly CAPEX is the main cost. Okay, the main cost we would have is CAPEX, and obviously you will have the second cost is OPEX. Okay, CAPEX would be during the initial stages. During the CAPEX stage, you will not have any production. Okay, so in general, let's say, one second. I don't have pictures, but I can just give a brief, right? So, 1 minute. Okay, this way. Right. So let's say this is your timeline, okay? And if this is your timeline, let's say this is a very simple approach of an oil well or a field plan, right? Or let's say your costs, or sorry, your overall free cash flow. Okay, so this area which you see is mostly the DevEx and CapEx. You can either call it DevEx and CapEx, or you can just call it CapEx and break that down into development and drilling and obviously development and drilling, right? This is an area. Right now, this is an area of your revenue. So once you are at a stage of, okay, producing oil, now you're gonna get your revenue, right? So this is an area of revenue, but mostly this cost is quite high, you see. The reason of this cost being high is now you don't have any revenue, and this is just an upfront cost, initial investment. Initial investment is quite, challenging, because nobody would be interested in spending a lot of money if you don't put up right numbers, or if you don't show them there is a potential of hydrocarbons, or there is recovery of hydrocarbons as expected, or as planned, right? So that's the main purpose of having capex, is getting capex or initiating capex is quite high, right? When you do field development planning, the first stage is how do you consider these numbers, right? So if you're doing the first stage, maybe you're at a greenfield project, right? So you have completed your exploration, you have all your data ready. Now you might have to do a field development, what's, let's say you have some decline, you have some data available, and how would you just put it up, right? So based on this, you need to create, right? You need to create a proper planning, analysis, and estimations of when would you go for drilling, when would your drilling campaign initiate, or when will your drilling campaign start, what would be the cost of your drilling, right? All that stuff, right? That is the main purpose of having a proper cost analysis, right? So I'll just sorry. Okay. So, CapEx estimation. So, CapEx refers to the upfront investment required to design, procure, construct, and commission an oil and gas facility. CapEx is estimated using three primary methods: CapEx factored, equipment factored, and analytic. There are different approaches, but as a basic understanding, you can use these, right? It includes direct costs and indirect costs, right? So, historical project data, suppliers, quotes, market trends inform the cost assumptions. Contingencies are applied to account for unknown risks, inflation, and project scope. Okay, the accuracy of estimates vary: plus 30, minus 30 for feasible studies, and plus minus for final investment decision. Right. So the main equipments in capex, let's say the main drilling equipments or the facility equipments, basically would be the main cost or main equipment cost, which will be around 30 to 40%. I mean, these are just general, overall. Data, each field or maybe each type of area have a different cost of structure, right? Pipeline installation maybe 20 to 30, instrumental cost maybe 10%, 20%, civil works, which is, let's say, the labor and other costs, you might have 10 to 20%, indirect cost, something maybe extra, you might have an cost maybe for 5 to 10%, and maybe admin or general cost can be around 5 other 10%, right? So your capex estimation is very important, right? Initially, your capex, because you don't know how, if it's a greenfield project, again, you don't know how the structure is, right? You might either have a lot of data. So the big companies, they have a structure, they have a plan, they already have a lot of data, so they just use it as a template. They have a data for X field, they're gonna use the same template for the new field. But the small companies, or maybe undeveloped countries, they might go for a consultant, or they might go for a consulting agencies, for, let's say, help them in designing or planning this entire phase, right? And in this phase, what is more critical, what are you trying to expect, right? So your capex, do you want your capex to be less, or do you want your capex to be more? Do you want your capex to be a bit more feasible? So you might have a condition, so you might create either a budget, or you might let's say I'm going to create my I have I'm going to keep my capex very stable. So you might expand your capex. You can your capex stage can only be around can be between 1 to 3 years, but because you have very less funds available or you don't have initially enough initial investment, you might expand your capex to 1 or 2 years, considering you're gonna bear losses as well with time. Okay, so these are the things which are very important in terms of capex estimation, right? Now, OPEX, right? So, CAPEX is something where you spend a lot of money, but again, OPEX is a big chunk of money which will be taken away from your revenue. So, once you start your production, you'll start generating your revenue, and major cost of your revenue will either be mostly will be the OPEX. Okay, so OPEX refers to the recurring expenses required to operate and maintain an oil and gas facility over its life cycle. OPEX includes fixed costs, variable costs. So, you have fixed OPEX and variable OPEX. Okay, fixed costs are labor, maintenance, and insurance, and variable costs are fuel, utilities, and raw material. Typical estimates as a percentage of capex ranging from 3 to 10% per year. So this is during an initial stage. Okay, very initial. Let's say you're just at a green field. You are at a very young stage. You just don't know any data. You don't know the numbers. Maybe things can be plus minus. So you might just go with an okay, my OPEX per year can be around 3% or 5% or 10%. Right? You just go with that. But once you initiate your production, with the planning phase, with time, once you start getting the numbers, when you start getting the exposure, maybe dealing with different other consultancies, getting a lot of data, maybe now you have enough suppliers and everything, then your OPEX can be estimated or predicted, right? So this includes energy consumption, spare parts, chemical waste deposits, heavy influence by market prices, inflation, labor, and regulatory requirements. OPEX directly impacts the economic feasibility and the NPV of the project. Okay. Now, when you're considering OPEX, right, two things are very important. When you consider OPEX, when you're gonna considering OPEX, they're gonna be two things which you need to add with your on your OPEX number, which is number one is your inflation, and number two you can be the LIBOR or the CPI, right, which will be the consumer price index, just say like the interest rate, inflation, and these things. These are very important because you will this will change with time and your OPEX will increase, right? Now, how do you estimate your OPEX? So initially, when you don't have your numbers, right, maybe you don't know how much OPEX would be. You might either use historical data, so maybe another field or past data, you might use it, or maybe use a bottom-up approach, estimate each component separately. So you might say you're gonna consider the overall project based on hours, okay, and on production. So production by hours, right? So how many laborers are working and how much is the production, how many hours is the production being done, or how many days is the production being done, right, or how many months is the production being done, right? So based on that you might do a bottom up approach, or you might do a top down approach where applies industrial benchmarks such as uh, okay, you just use some benchmarks or some criterias and put them as a number, right? And you might go for a sensitivity analysis using and evaluating the impact of oil price fluctuation, labor cost. Okay, that's what I was saying. So you might add, LIBOR, you might add inflation cost, you might add CPI or RPI, these type of value, just to make sure that your OPEX should always be more than what you're spending, because things change, right? Maybe if the suddenly market conditions change, maybe suddenly there's a new regulatory on the on operations, or maybe new regulatory on certain products, right? Your values may change or increase, right? So considering all that, you might just have an value as well. Obviously, interest rates change, so your time, the value of money changes every year as well. Again, fixed OPEX and variable OPEX is simple, right? So personal cost, maintenance, insurance, G&A obviously, and variable are uncertain. So fixed are, these are the numbers you would have, maybe just increasing with a certain percentage every year, which was again applied by the company or by yourself. But the variable OPEX is not in your hands. It changes with time or maybe market conditions, right? Those are the things, right? So, last but not the least, managing production and cost uncertainty, right? So, what is the main purpose? So, as said before, right? Cost, time, scope, time, cost, and quality, right? So, that's the end goal, right? So, everything should be under the scope. thing should be under the time planned or under time managed. The cost should be under the budget, the right budget. You should have the right budget. Every cost should be inside the budget. Maybe you might have little things can go under budget, that is good, but things go over budget mostly is something, again, it's a lot, it's going to be a loss, right? So either you recover the loss later from, when you sell your product or when you sell your hydrocarbons, or you're going to recover in a different manner by doing a different type of um, let's say planning stage, right? And last but not the least, the quality, right? So imagine if the crude or maybe whatever is your hydrocarbon or gas, right, it should be of a good quality and maybe as expected by the end user, right? That should how it should be. It's not that, okay, I'm going to produce this a number of barrels just because of the situation and the production is not stable, and instead of having 100 barrels you might only end up having 30 barrels or 40 barrels. That's not how it can be, right? So last but not the least, how do you manage this, right? End of the day, you need to balance your cost and your production, right? More production, less cost. Similarly, when you have higher oil price, increase your production with less cost, so you make a lot more margin or a lot more profit. That's the end goal, right? So you identify, quantify, analyze, mitigate, monitor, and last but not the least, go for an alternate if things don't go properly, right? So what are your risks? Production risks are reserve performance variability, well productivity and equipment downtime, right? Cost risks, unexpected CAPEX overruns, rising OPEX and regulatory changes, right? And use so these are the issues, or these are the general problems you're gonna identify. Then how do you quantify? So you have historical data, you might use a lot of different type of models, or you might have experts who are going to help you, different type of analog fields, maybe different number numerical or qualitative data, you might use them. Define probability distribution method, let's say production rate, you might run a Monte Carlo simulation or different type of probabilistic approach just to say that random situations what happens. That's how you're going to quantify. And then how do you analyze? Based on whatever you have, you're going to develop multiple scenarios considering a base case, best case, worst case, and base case. You might run again a performance test or sensitivity test on that, considering what how it would affect your net present value and internal rate of return. And how do you quantify probability of project success or failure, right? So maybe if your oil prices are very high, your production is stable, but due to you have a lot of other costs, you might have your OPEX too high, you might have your tax or your PSA conditions too high, where you're not going to make profit, right? You might go for a situation where you might have to halt the project, or maybe go for a renegotiations with the conditions of the overall project, right? That's how you're gonna analyze and mitigate, right? Now, how do you mitigate in specific is either flexible development plans, phase drilling, modular facilities, cost control, fixed price contracts, contingency budgets, production optimization using real-time monitor and adaptive management, right? So simple approaches, logical steps forward, but again, they're complicated, so you need to do it in a very pragmatic and structured manner. Last but not the least, once your things are going well, you might have to monitor everything properly, update forecasts and cost estimates with real-time data during operations. Maybe your forecast can be either too high or too low, but once you come to that time or that stage, you might have to update your data just to make sure your future forecasts, don't get affected in that manner. Last but not the least, if uncertainties happen, either you halt the well or stop the production, or maybe go for a different type of approach. Maybe if you have to enhance the production, go for a different enhanced recovery method. Or last but not the least, if you're going for a different terms and conditions, you might have to sell the project. So the better option can be selling it to some other company, or maybe some other companies acquires it. Maybe mergers and acquisition takes place there. There are different approaches, in certainty, in uncertainties, right? The North Sea, due after the COVID pandemic, many oil and gas fields or many oil and gas companies went for a mergers and acquisition. The main purpose was they could not mitigate with the uncertainties. One was the oil price falling too low. Second was the situations were not in control. So there are a lot of things when when they don't go in the right way, you either go for M&A, which goes for a better deal, right? That's the last but not the least, right? So understanding this is main perception, right? So you cannot say, okay, tomorrow my production is going to halt, I'm going for a M&A. No, that's not going to happen. because you're not in that situation. Maybe you need to go for an M&A, let's say 1 year before or 2 years before. You might just initiate or go for a planning, and for that you might approach a consultancy or maybe a bank or a merchant bank, just to say that okay, we are at a situation where we cannot anymore, survive, or maybe we cannot anymore spend a lot of money in production, so it's a better that X company takes up our company and we get share of so much because our value of our company is so much. So you do a proper valuation model for that, right? So for that you should know your NPV, IRR, and how it's going to work, right? So that's the end of the day. That's basically the overall production and cost analysis, right? So production and cost analysis, end of the day, is just to manage and mitigate risks. So manage uncertainties and mitigate risks, right? So you should have a proper production, a stable production, or let's say high production if you can, and less cost, right? Just to make profitability more. That's it. So any questions, any doubt, please let me know. And I think we are here. Yeah, that's it. That's the last. Thank you. And yeah, I think the Advantage team might have a very good program coming ahead. If we come up with a good program for this, we'll mostly do a proper Excel modeling, considering a lot of data, maybe a bit more calculations, just to make sure it's not too complicated. We'll not do a big high level calculations, but the basic calculations, which end of the day show how would your production, how would your cost analysis play a role, and how would that affect your net present value. Apart from that, we might use some let's say real-time data, maybe from different online resources, free resources, and try to understand what's happening there. How would that kind of, why did that happen, right? So maybe you use some real-time oil and gas data of, let's say, somewhere, maybe either in North Sea or somewhere else where you can have which is available, and you see how it's depleting and how it's declining. Have a proper understanding of how it's being done, and apply the same concept and use the same data and try to do a simple decline curve analysis and understand how would that affect your net present value and internal rate of return. Right now, what is the highlighted, the important area here is we do a proper field development plan considering the cost aspect. So how much would be the capex, how much would be the opex, when would the capex take place, and when the capex takes place, how would that affect the overall project, overall overall net present value, right? So these are very important, right? So each moment, because you're going to consider time value of money, right? So time value of money is a concept that is very important, where the value of money today is more than tomorrow, right? So considering this aspect, how would that affect your overall net present value and internal rate of return based on your production and your costs, right? So this is very important in terms of understanding or analyzing field development planning in the oil and gas industry, or just saying specific to oil and gas area. So we'll keep it a bit more intuitive and more brainstorming rather than keeping more like a theory. Okay. So thank you very much, guys. Any questions? Just let me know. Thank you. Over to you, Srirag.
Guys, anybody have any questions, please ask.
You can
If not, we can proceed.
put the
Yes, sir.
put it up in the chat box as well.
Yeah, we will wait for more 5 minutes. 5 minutes, then we will conclude it.
Sure, sure, no worries.
Sure, sir. Hello, sir. We can proceed to the concluding session.
Second.
Okay, guys. Thank you all.
No.
Thank you for attending this webinar. Thank you, sir. Please giving him for giving your time
Thank you.
and knowledge. Thank you, sir.